It's always been a core kind of initiative is to get the books up to date, get them every month by the 15th, and not just because you might need help or you might have an opportunity, but because you as a business owner need to review your books and see where things are at on a monthly basis so that you can make decisions.
Welcome to the High Voltage Business Builders Podcast, a show where we interview high voltage entrepreneurs growing and scaling through e-commerce, real estate, and other wealth without Wall Street ventures, showing you the path to making your first or next million. All right, folks, welcome back to the High Voltage Business Builders Podcast. As you know, we talk about e-commerce, business, real estate, financing, cash flow, deals, wealth without Wall Street alternatives, and all kinds of fun things. And today's topic is going to focus on the aspect of business building, financing, and e-com. So I brought a guest in today who is going to help us understand a little bit about what to look for, kind of the 5 things you should consider when cash flowing or growing and financing e-commerce companies.
Mm-hmm.
And Matt's going to talk to us a little bit about his background experience and what he's doing today. Matt, welcome to the call, man.
Thank you so much for having me.
So let's go ahead and dive in. So tell me a little bit about what's the first thing people should be considering when financing an e-commerce business?
When financing, the first thing, the most important thing is the payment terms. A lot of people would think, and I used to think that APRs or your effective interest rate was probably the most important. You know, where I'm at today, I focus on the payment terms more than anything else. And the reason why is because you could get a great capital at fairly low interest rate, but if you have to pay it all back in 4 months, a lot of times you're paying it back before you've sold all the inventory that you purchased. And so instead of your gross margin going back into buying more inventory to fuel your growth, your gross margin is paying off the lender. So then you have to take a whole nother loan to keep going. So for me, I wouldn't say irrespective of APR, but I weight the payment terms more heavily than I do the APRs now.
Excellent. And what gave you that experience? I mean, you're a seller, I assume, or you've had experience in this place. Tell us a little bit about that.
Yeah, so I own a brand with some partners as well called Keep Nature Wild. And I also work with, 15 brands around the world. And what I've seen in the early days is, you take a loan and it's a great rate and you kind of filter for that. And then, you end up paying it off and selling your inventory. But what I've noticed is that you have to keep redrawing all the time. And one of the goals that I have with clients is to eventually get them off of financing as a growth tool, but using it strategically when you want to, not because you have to.
Yeah.
And so that's what I noticed is you just had to keep redrawing.
Yeah. So there's something, in my experience, if there's something about the requirement of constant capital without cash flow, it's either you're taking too much and too much cost of inventory, or you're simply not selling through fast enough, or you're taking too much money out of the business and causing it to force financing. Are those similar things that you see in your line of work as well?
Totally. Yeah. I mean, adding too much fixed costs, overhead, and overbuying inventory, all those things kind of factor into why you might need more cash. But I mean,
Yeah.
It depends on which lender you go with, right? But some of these ones, some of the financiers out there, just the way they've set up their capital sort of forces you to redraw to keep going.
Yeah. Which probably leads us into topic number 2, right?
Good. Yeah. Sorry, what was topic number 2?
Well, you had a list of 5. We were on number 2 now.
Right. Yes. Okay. Sorry. Sorry, my bad.
No, we're taking tangents and we're coming back.
Got it. Okay. So yeah, topic number 2, I mean, in terms of protecting cash flow is be cautious with fixed expenses and overhead. Do more with less and force yourself to do more with less, even when you're making good money. Where I've seen issues time and time again is when people have a great year or even great 2 years, and then they add some fixed overhead, some fixed expenses because they want to, maybe have an easier go of it, or they want to grow. And then there's a turn in the market or the economy like there is right now. And so then those additions cause trouble. And so from my point of view, being very cautious with adding fixed expenses is very prudent. You can use VAs, you can use agencies or contractors, but just keep it as lean as you can for as long as you can.
Yeah. It's what we consider to be keeping your exit potential in mind, not necessarily pulling all the profits right now, but looking at the growth trajectory and, of course, the scalability of the business for possible exit.
Totally.
A lot of maximum profit can come at time of exit. So as a third thing, what am I thinking of here? What are we talking about?
Yeah, I mean, the third thing, for a lot of e-commerce sellers and Amazon sellers, like ad spend is a big deal.
Mm-hmm.
And so one of the key things about managing your ad spend in your agencies is to give them clear guidelines on how you're going to give them a budget. I've seen people give budgets in hard dollars. That's suboptimal because
Yeah.
you can spend dollars poorly or wisely.
Hmm.
The best way that I've seen it, and this is something that Viore does also, they give a flexible budget based on certain metrics. So you could use MER, marketing efficiency ratio. I like to use contribution margin. Contribution margin is basically what is left from a dollar of revenue after removing every variable expense. And so a good contribution margin is above 20%, 15 in some industries, I would say. And so what I like to do is tell the agencies or the media buyers, look, if your contribution margin is over 20%, spend as much as you want. Because what that means is that every dollar of spend is returning to you 20 cents. And that's great. And you don't want it to be too high either, because it means you're not capturing market share that you could reasonably capture. Now, you could decide to let it go to 30, 35. I've seen that before. But when you're looking for growth, a contribution margin of 35 is really too high, because it just means you're not capturing as many customers or clients as you should or could. And so when you look at your agency, tell them, calculate, you look at your past 3 months, calculate your contribution margin, what is left over after every variable expense is taken out, and then give them a guideline saying between this number and this number, spend as much as you want. Once you start to hit that number, call me first before you keep going.
Or people refer to as a ROAS, right? Return on
Yeah.
advertising spend, and more of the direct to consumer marketing world, which I appreciate because obviously one of the things that a lot of people make mistakes on as amateur Amazon sellers is they're thinking one product, one sale, and then they don't really think about what it takes to get the second sale, third sale, fourth sale, what additional products need to be in the market for that back end. So they heavily weight too much profit and too many razor thin margins on their marketing on the first product, trying to make it the ultimate profitable deal.
That's right.
And instead of looking at it as a portfolio of products that customer can buy that create additional value, they put too much weight on the front end.
100%.
And they put too much marketing. So they limit certain dollars. They limit their average cost of sale to like 30%. I can't spend more than that, or my product isn't going to be profitable. And at that point, in some cases, based on where they're playing in the market, either we're not competing with them as sellers ourselves, or we're going to beat them because we're willing to spend 70% a cost
Exactly.
to go get their customer, and they simply can't follow us. And why can't they follow us? Because we're typically doing a slightly different branding, and we're doing a different retail price point and a different avatar selection that's really going to compete.
Right. And we spoke about that, I think, before.
Yeah.
You mentioned you can use a very high ACOS, and that makes so much sense when you have a plan to serve more products and all these things. And so if you do, I mean, again, it's just to kind of figure out what is the collar and the cap for your agency based on who your business is, what you sell, who your customers are, how much they come back. But then, tell them just to go within those bounds. But like you say, some people I've seen spend 50% of revenue on advertising, but they had a very clear plan, they had a hypothesis, and they had kill points where if this initiative wasn't working, they knew when they were going to pull it back and how they were going to pull it back. Right. So you can be super aggressive as long as you know those things.
Well, there's certain metrics, like one of them is click to sale ratio. So it had to be how many clicks to each sale. And is that ratio 10 to 1? Is it 20 to 1? From those numbers, I can extrapolate into how many additional clicks you can take per cost of sale while still either keeping profit or just above to acquire that customer with the sole purpose of getting them to buy more products from our brand. And so it isn't that you make the product unprofitable. It's just how do you strategize an approach to a competitive market, especially if they're already setting in Amazon and you're coming new and they got 3,000 reviews. If you haven't correctly identified your competition, you're not correctly setting the right plan in place, you're not going to eventually overtake them. So we typically want to see more products and a portfolio of products, which many sellers don't really visualize that initially because a lot of them are just getting started in some ways and they only think first product. And they're stuck in the what the hell do I sell mode. So they haven't even figured out what am I selling yet. I can't imagine selling 5 because I can't quite figure out what 1 is at this moment. But it's important for people to think down the road, if they're listening to this call, hopefully you are, as to what it takes for your total advertising cost of sale to affect your revenue as well as your profit bottom line, as less than what it takes for me to acquire a customer to ensure I beat them with my competition. They buy my product and not someone else's. That's a first level win, obviously, in market competition.
And then how do you, am I allowed to ask you questions?
Of course, go right ahead.
Cool. So how do you, and so how do you, when you look at, getting that customer on the first product, what are your kind of strategies to get them to come back and buy your other stuff in your universe in an Amazon context?
Well, I mean, obviously, market share in Amazon has to do with distribution. And if obviously you can get more search engine rankings for your product, you obviously create a wider net of people who could
Mm,
capture across multiple keywords. So typically, our first products are going to be products that have a minimum of $10 in profit per unit. So we're not going to play in the sub $30 product range right out of the gate. We're going to set for more tier two avatar for products 50 to 125 in range, which is going to give us the profitability to take first market acquisition in that product right out of the gate, setting us up for second, third, fourth products that are going to
cool.
fall in line with that avatar's buying patterns. So if they buy product A, we already want to know that frequently bought products or other products behind them, they're buying already from someone else and
Mm,
trying to determine if the CLTV, customer lifetime value of them, is equatable to one Prime member who spends $1,000 in 1 year on Amazon. And if that's the case, and that is my back end, then any products, marketing, sponsored ads, brand packaging, email follow-ups, and other marketing mechanisms will drive them into purchasing 2, 3, and 4, and 5 products, getting as
cool.
close to $1,000 as possible in 1 year with them. So nobody really thinks in the Amazon world, in my experience, very much, just a few, about what true e-commerce actually is. When you
Yeah.
acquire a customer, bring them in, you upsell them, you market them, you email them, you do traditional direct-to-consumer marketing strategies. They don't apply that
Hmm.
very much in the Amazon world. I'm not sure why
Yeah. No. Yeah.
they
You're right.
aren't
Yeah.
doing it. There are some doing it very well, like Seth and the guys over at Post Purchase Pro.
Yeah.
They've really figured out email marketing on the back end is an amazing way, when done correctly, to pull second, third, fourth customer acquisitions out. So when we, again, to answer your question as succinctly as possible, we think as first product as only first go to market touch point. And from there, it's multiple product touch points that we're after. We're creating a portfolio of products.
Awesome. Very cool.
So number 4, what's on your brain there?
Yeah. Number 4, I would say an important one, which might sound counterintuitive, is keep your bookkeeping up to date and make
Hmm.
sure it's done well. The reason why, I mean, that part's intuitive. If your books aren't in order and they're not up to date, you have no idea what's going on with your business. If it's over a certain size, you just can't keep track of your expenses, all that stuff. And the other reason to keep your books up to date is because you never know when you might have an opportunity, or you might not know when you might need money. And so if your books are up to date, it allows you to access those opportunities quickly. When the pandemic really sort of started in Canada, we had some government programs where they were offering support to business owners. I spoke with probably 400 business owners in that, first 6 months, 8 months, to try to help them access that help. The
Yeah.
number one reason they couldn't get it is their books weren't up to date,
Hmm.
or they weren't filed with their accountant on time, things like that. And
Right.
so since then, it's always been a core kind of initiative is to get the books up to date, get them every month by the 15th. And not just because you might need help or you might have an opportunity, but because you as a business owner need to review your books and see where things are at on a monthly
Yeah.
basis so that you can make decisions.
Yeah. Great point. And it's very important to understand that's something you should do from the very beginning. If
100%.
you were really thinking of this as a business, right, not a side hustle or a hobby, then you're
Yes.
going to want to put that piece of the foundation in right out of the gate, bookkeeping and accounting, a smart chart of accounts,
Yeah.
to ensure that you understand, as difficult as it is at times to look at those numbers and not feel depressed in some cases, folks. I mean, because they don't want to look at it. They just like, well, I don't want to look at it. If I don't look at it, it doesn't exist.
I know the
And,
feeling.
it's tough being a business owner at times when you have to look at the negative things and you have to refocus them or look for opportunities to avoid those problems. And right out of the gate, just getting that mindset in place with your books, very smart. I agree with you 100%. Get those things in order, get the bookkeeping out of the gate right, and get a good financial numbers plan in place and understand your numbers very clearly
Hmm.
in the business. It may feel bad at the beginning or somewhere during the line, just as things get moving or whatever, but keep pushing forward and watch the numbers. That's a very,
100%.
very important point. Absolutely. All
Yeah. I
right. Well,
mean, for me, even when I had I think I hired a bookkeeper when I had my second client only. And
yeah.
so doing barely any work at all, I just had to have a bookkeeper because I don't like doing it. And I knew I
Yeah.
needed my books up to date. So yeah.
Yeah. It may cost you a few $100 to get the chart of accounts and stuff set up with an
Yeah.
accountant and get that stuff in place. And you can do QuickBooks Online and stuff. We do that
Hmm.
too. And it can connect to Amazon and do your transactional logs. And then a bookkeeper, anywhere between $29 to $59 or $79 a month. Not a
Totally.
huge expense for someone who gets in and line items each transactional item
That's right.
and keeps that thing up to date. Not a huge expense, but a very big value to the company.
Mhm.
So make sure, people think, oh, it's going to cost me hundreds of dollars and thousands of dollars a month to keep all that.
No.
You can't, it actually doesn't anymore, right?
No, not
Um,
at all. And there are some great, so one company, I'll just plug them. I mean, I don't get any money from them,
sure.
but Ecom Balance, run by Nathan Hirsch.
Going to mention them and Connor. Yeah.
There you go. That's right. Yeah,
Ecom
they're
Balance is who I'd
fantastic.
recommend. Yeah. They are amazing. Great reference.
Cool.
Yeah. Absolutely. All right. What's your final thought?
Yeah, so I want everyone to have a forecast. So it doesn't have to be complex. I mean, the ones you get from me are very complex, but you can start off by printing out a monthly profit and loss statement from QuickBooks and then just appending your thoughts to the other side of it. So you pull it from, let's say, prior 12 months to last month, and then type in your assumptions for the future months. Just drag the formulas over, type in your assumptions, make it simple, and look and see what your profit is. Profit is not always equivalent to cash flow, but generally speaking, if you're consistently profitable, cash flow should be there. Now you might be buying a lot of inventory, but that's another thing. So, but I would say everyone should have a forecast of some sort, a budget of some sort for at least the future 12 months. And again, like I say, print out from QuickBooks, just type in the numbers. And when you're making decisions, should I do this? Should I hire this person? Should I accept this deal from this wholesaler? I want you to go into your forecast. I want you to adjust the numbers for how that deal would affect your budget. Then I want you to make the decision. Don't do it. Gut is important, but this is one data point where you can help your gut make the decision is. So let's say I want to hire an ops manager. I'm going to pull up my QuickBooks very simple budget, and I'm going to type in whatever it is, 5K a month, 6K a month going forward. And I'm going to see, what does it do to my profit? How much is it affected? Can I still make money? Test everything in your forecast. Yeah. Test everything always.
Very smart. It's good to have your mind thinking. Obviously, plans change of mice and men, as the saying goes. But of course, having a forecast is important, at least to understand where your roadmap is, where you're going. And of course, by the numbers, as you mentioned very astutely, know where you are, know where you will be in the next 2 weeks and where you could be in the next 2 months. And of course, you'll adjust that and change with market and conditions and whatnot. But it's very important to think that far forward. Even as you're launching your first product and even as you're getting your business off the ground, it's okay to have big, hairy, audacious goals, BHAGs. And it's great that everybody wants to get to 7 figures and have that lifestyle. And we totally get it, right? Everybody understands all that. That's still part of the hopium thing. So we want to pull back on that for a moment and remember that you got to climb your way up there first. We got to get first product, second product, 10th product in the market. You've got to get that profit and loss going. You've got to have your bookkeeping in place. You need to be prepared to do fundraising if necessary to move to the next step. And I guess that's kind of one of my final things here is fundraising and raising capital. When in all of those things, as they're getting going and moving and stuff, do you normally advise people to get capital or look at capital or, pros and cons of capital raising, right?
So are you talking equity or debt or anything?
Well, we can talk about any kind of, because there's all kinds of, there's product investment and business investment and capital investment. And oh boy, there's operating agreements and SEC. You can go all over the place with this thing, right?
Cool. Well, let's talk about debt first. So when should you get debt is 6 months before you need it. And I mean, that's a funny way to say that, but the reason I say it that way is because no lenders want to give money to people that really need it. And so you want to, if you think you might need it in 6 months, just go get it now. It'll make it easier to get it, and the banks will love you for that. And you won't have a problem in 6 months when then you're in the middle of your problem trying to get financing. It's just not fun. So be early. How can you be early? Well, this comes back to testing everything you want to do in your budget or your forecast. So I'm not opposed to taking losses in an interim time frame when you have a solid plan to make profit, but you need to know how much loss am I going to make and how much money might I need to survive the 3 months I plan to make a loss for, 12 months, whatever it is. So be early is the big one with that. With equity, not everybody needs it. A lot of people could use it. I think one of the things with equity from my point of view is you need to have a pretty clear path to what the return might look like for the equity holder. But when I think equity is important is if you want to make a loss for a slightly longer time frame in anticipation of growing, then you should use equity. What I mean is, let's say my business is doing $2 million a year and I know that I can get to 10, but I need to invest in some product dev. I need to hire a CMO and all these things. And so you might then create some losses for 12, 18 months, 24 months sometimes on your path to get there. that is a time that I would look to raise equity for that. I wouldn't fund it with debt if I didn't have to. The reason why is because debt requires payments. And so not only will you be making losses, but you'll also be making payments on the debt. So sometimes it can work, but that's a great time to take equity. If you want to get to, from 0 to 8 figures very, very quickly, equity is also a really good option for that. Because again, you're just going to have to spend a lot of money and hire some very smart people fast. And again, hopefully the bet pays off. It does for a lot of people, but doesn't for some people as well.
Yeah. I'm always cautious to take the operating into a equity position. And I would just, in my own experience, because it creates, it can create entrapments, it can create an opportunity. But most people dive into, well, if I need to get money in my business, I have to give up equity. It's kind of the de facto idea of basis that most people kind of get from, I don't know, internet YouTubers and whoever else is talking about all the time.
Yeah, totally.
But there's getting equity in the product too. There's bringing in product partners who may be funding an inventory level business, but not actually taking equity in the business, so that you don't have to give up ownership in the company and control, but you can also capitalize your products without having to create equity or equitable positions that require operating agreements and shareholders and the voting rights and this kind of stuff, which get a little bit more complicated. That's typically, I would say, in my opinion, reserved for much larger tranches of capital, where you may be taking on, millions of dollars in capital growth versus tens of thousands to hundreds of thousands of dollars.
Totally.
So it's, there's basis points, I think, in there to argue the win and wheres of those. But I would always caution people to be careful to give up equity. And I agree with you on your points for sure. Equity has its place. Just make sure you understand when.
Well, exactly, right. And you can find it if you've sort of proven product market fit and you have a reasonably conservative, solid plan. I am not opposed to taking a lot of debt if you need it. And I have a client that I'm working with actually that has identified a very strong pipeline. They know what it's going to cost to get the pipeline and manage it. And so for them, they're thinking about taking $1.5 million of debt to fund a loss for like sort of 9 to 10 months. But then the deal will close. And obviously they're going to wait till sign something before they do this. But in that case, why would you take equity if this deal is going to spin off a whole bunch of cash and equity and profit?
Right.
And you just need this piece of debt, right? So there's, I wouldn't give away equity before you had to.
Yeah. Well, it's kind of, again, that's a cautionary tale because that's what people usually will hear first is, I've got to get out equity or I'm going to give 50% of my company to someone else. I would be very cautious about the challenges that or the resolve and that, especially if you don't have a working history with that person or organization that's taking over that equity, and that you're very cautious about the terms and specifically the operating agreement and understanding your, place in it as well as your legalities. So you don't end up within a liability or a litigation, which you don't want to get, what looks like could really be a great deal in 6 or 12 months suddenly turns into all my time is being spent defending myself or my partner or whatever the case may be. And suddenly the business is in a tricky situation you don't want to get involved in. So just be smart about it. That's a great and very wise input today, Matt. Clearly, you know what you're talking about. You know the details of this business model. Tell us a little bit more about what you've done and what you're doing in the coming year with your business and what you're looking to do.
Yeah, so we're growing really fast. I could grow faster, but I want to maintain like a really high quality of service. And so I'm not growing as fast as the demand would allow.
Yeah.
We are working on SOPs. We're working on where we want our corporate structure to go. We're working on how we're going to deliver it. I'm hiring a fractional COO to come and help me figure all this out. And where we want to go, I mean, we want to help more business owners grow the businesses with more cash and less stress. And some people can't afford our service. And so we're trying to find ways. Can we do coaching? Can we do courses to kind of unlock our help for others? Can we make templates for people? So there's a lot of things we want to do. Our guiding light is helping entrepreneurs scale their businesses with less stress and more cash. Like that's the whole reason we're in existence. And we're just going to do whatever we can to serve as many entrepreneurs as we can.
Fantastic. And where can they go check out more information about you? You got social networks, media, et cetera, things we'll
For
put
sure.
in the bottom, but if you want to make a call out real quick.
For sure. Yeah. I mean, best place to hit me up is LinkedIn. I'm very active. Check it every day. So just Matt Putra on LinkedIn. You can go to my website, 8x.co. You can book with me from my calendar link there. But you're welcome to just DM me on LinkedIn. If you have a question or something you need, send me a DM. I turn a lot of DMs into posts for other people. So you're more than welcome to ask me anything you want. I connect with everybody. So yeah, that's where you'd find me.
And I appreciate having you on today, folks. If you liked what you heard today, please go Put this on social media, share it with your friends. If you loved it, leave us a review, give Matt a shout out, go check him out on LinkedIn and other places. We'd appreciate it greatly. Matt, thanks for coming on, brother.
Thank you so much for having me.
If you like this episode, please share it with people you think will enjoy it as well. Thank you for listening, and be sure to tune in next week for a brand new episode of High Voltage Business Builders.